You're listening to the Financial Source podcast on YouTube.
Welcome back to the Financial Source podcast. Today we're looking at a market that feels like it's being pulled in two different directions at once.
It really is. On one hand, you have these instant geopolitical flare-ups creating volatility.
And on the other, you have these much slower, but maybe more important shifts in global trade.
Exactly. We saw oil futures surge on twin geopolitical flashpoints, forcing traders to, completely reassess supply risk near the Strait of Hormuz and in the Black Sea.
Right. But while all that's happening, Washington is quietly accelerating these huge structural trade deals that are set to redefine industrial supply chains for the next decade, especially in Asia.
We'll dig into the specifics of those new frameworks, take a look at why the British pound is suddenly a barometer for UK fiscal health, and see how rising tensions between China and Japan are feeding this broader risk-off mood.
If you want to understand how today's energy spikes are really connected to these longer-term shifts in currencies and chip manufacturing, you're in the right place.
Let's unpack it.
Okay, so we have to start with the most immediate market mover this week. That was, without a doubt, the sudden jump in crude oil. It felt like it came from two places at once. Can you walk us through the hierarchy here? Which one of these events really mattered more to traders?
Well, the primary event, at least in terms of systemic risk, definitely came out of the Middle East, right near the Strait of Hormuz.
The choke point.
The choke point. I mean, you're talking about 20% of the world's oil supply passing through there. So reports that the Iranian Revolutionary Guard tried to redirect a crude tanker, the Talara, that gets attention.
And UK maritime authorities flag it as possible state activity, right?
They did. And when a state actor starts messing with shipping lanes, especially there, the market immediately prices in a worst-case scenario.
So that's the big one. What was the second event?
The second one was in the Black Sea. A Ukrainian drone strike actually damaged a Russian oil depot in the port of Novorossiysk. So it's not just a threat, that's, immediate physical damage to infrastructure.
And the combination of the two just forced an instant repricing. We saw both Brent and West Texas Intermediate pop, about $2 a barrel at their highs?
Yeah, around that, it just confirms that this geopolitical risk premium is now firmly baked into the price of energy.
And it's not just sentiment.
No, not at all. It's being reinforced by actual tightening supply. I saw that Qatar raised the January premium for its Al Shaheen crude. That's a huge signal from a major producer that things are getting tight in the region.
So how does that fear in the energy market spill over? We're seeing a pretty firm risk-off environment everywhere else.
Oh, absolutely. The mood is cautious. U.S. equity futures are weaker, kind of echoing that tech-led slide from the day before, and European stocks are under pressure too.
So investors are backing away from risk.
They are. But what's interesting is how they're doing it. Gold has been surprisingly flat, so they aren't, panic buying the traditional safe haven just yet.
But copper is down.
Right. And copper is such a great barometer for global industry. When the market gets nervous about instability, manufacturing slows down, and the price of copper reflects that mood perfectly.
Okay, let's shift over to currencies. The U.S. dollar has been, pretty steady, holding a tight range in the mid-99s on the index.
Yeah, it's quiet, waiting on some delayed economic data.
So the real chaos this week wasn't in the dollar, it was in the pound.
Oh, it was a spectacular mess. Just a perfect example of how fast markets pivot on perceived political stability. Sterling was all over the place.
And it started with a really negative shock, didn't it?
It did. The first reports suggested that the chancellor, Reeves, was abandoning plans for an income tax hike,
Which the market hated.
instantly. The read was, this is fiscal weakness, the government's scared to make tough choices. That triggered a wave of gilt selling.
And for anyone listening, when investors dump UK government bonds or gilts, it means they're worried about the UK's ability to manage its debt.
Exactly. And that fear drags the currency right down with it.
But then, almost immediately, the story completely flipped.
It did. A counter-narrative hit the wires, saying the U-turn was actually driven by improved growth and wage forecasts. The suggestion being, that tax hike wasn't needed anymore.
So it wasn't weakness, it was strength.
And that reframing just sent cable flying. It spiked all the way to 1.32 before it settled back down. But the key thing here is the speed. The market didn't wait around for confirmation. It was making a real-time judgment on the government's credibility.
That makes the pound a fascinating barometer right now. What about the other major currencies?
Well, the euro is a little bit softer, but it's holding above 1.1C, helped by that general dollar softness.
And in Asia?
In Asia, the Japanese yen is still stuck below 155 against the dollar. There's deep skepticism right now about whether the Bank of Japan has the ability or even the will to step in and stop the yen from weakening more.
I did see some movement in the Kiwi and the Aussie dollars.
You did. The New Zealand dollar is actually the outperformer. The central bank there confirmed that mortgage lending restrictions, the loan-to-value rules, are going to ease as planned.
Which stimulates the housing market.
Right. It's seen as a bullish sign for the whole economy, so that gave the Kiwi dollar an immediate lift. The Aussie dollar tried to rally above its 100-day average but couldn't hold it.
Okay, so that covers the immediate, firefighting in the markets.
Yeah.
Let's pivot to what is arguably the much bigger long-term story.
The shifts in U.S. trade policy.
Exactly. This isn't just about tweaking a few tariffs. This feels like a fundamental rewiring of global supply chain architecture.
It's a tectonic shift, and it's really about strategic alignment disguised as trade policy. The biggest move this week, by far, was the deal finalized between the U.S. and South Korea.
The scale of this deal is just immense.
It is. I mean, you've got approval for $150 billion in Korean shipbuilding investment, another $200 billion in other strategic commitments, and the U.S. even gave South Korea the green light to build nuclear-powered attack submarines. That is a massive strategic commitment.
And it's deeply reciprocal.
Yeah.
South Korea commits to buying $25 billion in U.S. military gear, and in return, the U.S. lowers tariffs on things like cars, timber, and maybe even pharmaceuticals.
Which helps with inflation pressures back in the U.S.
But for anyone listening who's trying to figure out the next 5 years in tech, the really critical detail here is about chips and currency.
Absolutely. This is the nuance that changes the game. South Korea got a guarantee that its chip tariff treatment will be no worse than Taiwan's.
And that's not just a friendly gesture.
No, it's a strategic hedge. It creates a powerful incentive to diversify advanced manufacturing away from the immediate geopolitical risk of Taiwan, while making sure the U.S. still has access to that tech through a very strong ally.
And explain the second part of that guarantee, the coordinated foreign exchange market stability measures. That sounds very technical. What does it actually mean for a trader?
In simple terms, it means they're promising not to get into a currency war with each other. They agree not to deliberately devalue their currencies to make their exports cheaper.
So it creates predictability.
Exactly. And you need predictability when you're talking about relocating multi-billion-dollar manufacturing facilities. It takes currency risk off the table.
And this aggressive push on trade goes way beyond just South Korea, doesn't it?
Oh, yeah. Washington is working on this on multiple fronts. They're preparing new tariff exemptions to try and lower U.S. food prices. They're building a whole new reciprocal trade framework with Brazil.
And we're seeing these smaller but still important market-opening deals across Latin America.
Right. With Argentina, Ecuador, El Salvador, and the modern twist is the quid pro quo. In exchange for market access, these countries are agreeing not to impose digital service taxes.
Which is all about protecting U.S. tech companies.
Precisely. You also have positive talks happening with Switzerland. So yeah, this has been an incredibly active week, really laying the groundwork for how global supply chains are going to look for the rest of the decade.
And all of this is happening against a backdrop of some really high geopolitical tension, which feeds right back into that risk-off mood we started with.
It does. East Asia is particularly tense right now, specifically the friction between China and Japan over Taiwan.
What was the spark there?
The spark was when Japan's Prime Minister Takaichi said that a conflict over Taiwan could threaten Japan's very survival. Beijing's reaction to that was unusually sharp.
I saw that. They summoned Japan's envoy.
And issued a warning that Japan would, and I'm quoting here, only suffer a crushing defeat if it dared to take a risk. That kind of language really chills risk appetite across the whole region.
And we can't ignore the military posturing happening closer to home either.
No. There are reports that senior U.S. military officials have presented President Trump with operational options that include potential strikes in Venezuela. The market does not take that kind of news lightly.
And that's tied into this new Operation Southern Spear.
It is. It's a new operation targeting narco-terrorist networks in the Western Hemisphere. So you've got active military planning happening not just in Asia or the Middle East, but right in America's backyard.
And finally, back to the Middle East, beyond just the Hormuz incident.
The risk profile there is still acutely high. We're seeing reports that the Israel Defense Forces are preparing for a limited offensive in Lebanon against Hezbollah. So when you add it all up, Iran, the Black Sea, China, Japan, Venezuela, Lebanon, it's crystal clear why investors are feeling defensive.
So to try and pull all this together for our listeners, You're basically navigating two things at once. You've got this immediate geopolitical stress that's directly spiking energy markets.
Right.
Then you have this massive, rapid reconfiguration of global trade that's going to have huge long-term effects on currencies. And on top of it all, you have localized political risk, like we saw with the pound.
And that raises the critical question for you as an investor. What do you do with this information? I think the most valuable skill right now is learning to separate the transient market noise, like that brief sterling spike on a rumor, from the really fundamental, long-lasting shifts.
Like the U.S.-South Korea deal.
Exactly. That deal fundamentally alters supply chains for a decade or more. Understanding that distinction between the noise and the signal is everything.
That covers a critical amount of ground, from the Strait of Hormuz to the architecture of global chip supply chains.
Thanks for tuning in for this essential market update.
Thanks for being here. Join us again next time on the Financial Source Podcast for more critical analysis.